Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Bringing Investment Banking to Advisors, How Elite Teams Get the Clarity They've Been Missing. It's a conversation with Sam Anderson, Chief Capital Officer and co-head of Dynasty Investment Bank at Dynasty Financial Partners. I'm Louis Diamond, and this is the Diamond Podcast for Financial Advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
For the largest and most sophisticated advisory teams, the industry has reached an inflection point. Private equity continues to reshape valuations and deal structures. Retire-in-place programs at the wirehouses have become meaningfully more competitive, and multi-billion-dollar teams increasingly find themselves evaluating not just where to go next, but why, and what each option means from both the strategic and financial perspective. Yet one thing has become clear. Most advisors have never had access to true investment banking level analysis around value, liquidity, and long-term economics. They've been forced to make the biggest decisions of their careers with incomplete or incomparable information. That gap is exactly what inspired the creation of the Breakaway Investment Banking Initiative, a joint effort between Diamond Consultants and the Dynasty Investment Bank, designed to bring objective, institutional-grade financial insight into the advisor decision-making process. Not as a sales pitch, not to push advisors toward any one model, but to give large teams the clarity and intelligence they deserve before choosing their next chapter. That's the center of today's conversation. Sam Anderson, Chief Capital Officer and co-head of the Dynasty Investment Bank at Dynasty Financial Partners, and I discuss how private equity has influenced expectations, what's changed in the breakaway landscape, and how teams can evaluate the full spectrum of options from independence to W-2 transitions, minority sales, recapitalizations, and more. We also explore the competing priorities that often emerge: autonomy versus economics, short-term liquidity versus long-term value, and the tension between control, culture, and financial opportunity, and how the Breakaway Investment Banking Initiative provides greater clarity to help advisors make critical decisions. It's an objective, candid look at the strategic and financial considerations that shape the biggest decisions large advisory teams will ever make. But one last note from the legal department. Dynasty Investment Bank services are offered through Dynasty Securities LLC, a broker-dealer, member, FINRA SIPC, and a wholly owned subsidiary of Dynasty Financial Partners LLC. Now let's get to it. Sam, thank you for joining us today.
Thank you. Appreciate you guys having us.
Absolutely. This is an exciting episode. So why don't we start off? Walk us through your personal and professional journey and what led you into becoming an investment banker.
I spent most of my career at Goldman investment banking, but before that, one of my first jobs right out of school was helping build the private wealth management group at Smith Barney with Sherrill. And we started out together in college. And so coming back to work with Sherrill has been a great pleasure. But I started out early days in the wealth management business, really on the grassroots building the platform, and then went to banking and covered the broad swath of FIG, including wealth and the RIA space. And I'm pleased to be back with Sherrill many years later. But it's a great space and there's a lot of activity, which is exciting.
Did you always know you wanted to be an investment banker?
It's a great question. I always ask interviewees that question and like, why do you want to be an investment banker? I grew up, not in a traditional banking family where my dad wasn't a banker and wasn't very Wall Street oriented, but I started right out of school with a senior thesis on, I was an economic major, but started out of school wanting to do it and loving transactions and loving spending time with clients. So it was a natural fit over time.
Yeah, makes sense. And you mentioned you spent a bunch of time at Goldman and Smith Barney before that, and then you joined up with the Dynasty Investment Bank. Can you describe your investment banking career pre-Dynasty Investment Bank?
I built out a couple different groups at Goldman and started right from the early days going through analyst associate. Actually, was one of the few associates that got promoted through without going to business school, although business school is great. But I was lucky in that respect because I already knew what I wanted to do. And we covered a lot of the different areas within FIG, but had done a significant number of transactions in the wealth space at Goldman. And then ended up going onto the client side and helping bring a client's company public, helping run that business. So I've been on the other side. I refer to myself as a reformed investment banker because I've actually seen it on the other side. And then was lucky enough to join up with Sherrill and Harris, who's my co-head for investment banking, who's great. This is a long history of doing transactions in the space. And he grew up at UBS, so we have slightly different perspectives on the world. But between the two of us, we've done probably over 50 billion of M&A in the space and have a long career of raising capital in the space. And it's a great team, and Harris is a great partner.
Amazing. So for those who are unfamiliar, maybe even less familiar with the Dynasty Investment Bank, separate from the Dynasty Financial Partners parent company, can you describe the investment bank's mission, what your capabilities are, and why the business was launched in the first place?
Dynasty, as from an ethos perspective, is to make advisors' lives easier and support independence. And part of running and owning your own business is how am I going to finance it? What am I thinking about long-term strategically? What are my plans for my business, whether it's transitioning to G2 or raising capital or ultimately monetizing and selling, and importantly, acquiring businesses along the way, whether they're tuck-ins or what we would consider a real transaction acquisition. And as these businesses get larger and more sophisticated, the need for a real advisor to help with that process, I think, becomes more acute. And so how does that fit within Dynasty as a whole? As we're supporting these entrepreneurs into independence, one of the key support functions is that key strategic advisor to the business, and not just the technology and the platform and the services and the operations piece, which are really important and critical to running your business day to day. But in terms of building out wealth as the owner and their partners and future employees working on the business, just not just in the business, is really important. And we think a core piece of what makes people and their business successful over time. And so we want to make sure that we offer that to our clients. We do, as part of our core offering, we support acquisitions along the way. So what does that mean? Like, we're actually doing the modeling, the forecasting, the valuation work, helping to build the term sheet, helping them to develop the acquisition model for going out and doing either tuck-ins or full-blown acquisitions. And a lot of folks right out of the gate, if they haven't been independent previously, they haven't done a transaction. They need some advice along the way to get that right, whether it's making sure they're in the right flow with the right legal advisor or the right tax advisor, and making sure they're mapping out their cap table, their securities, their equity incentive plan, all of that with a line toward like, how do we create value for the partners along the way and grow the business? And I think that from a Dynasty perspective, anything we can do to help people be successful is really in keeping with our ethos and our culture.
That makes sense. And is it that the investment bank is just built to help Dynasty firms buy other companies as a buy-side advisor and represent them as sell-side advisors, or does the bank support non-Dynasty affiliated firms?
Yeah, both is the answer. And Harris actually led a great transaction this year, Jenkins Wealth, which was a really interesting transaction, which was outside of our network and produced a great result for the entrepreneur and owner. He was able to simplify his life and sell a piece of his business that It was non-core, but yet we got a great valuation for. And certainly we cover everyone outside of Dynasty's network, but and internally we do help support acquisitions, but we also help support capital raising and monetization, which can be a line that's blurred sometimes when somebody wants to sell 40% of their business. Oftentimes it ends up being 51. And oftentimes the multiples that come in from strategics are so attractive that they decide to sell the whole thing. And that's more of a lifestyle sort of personal decision for a CEO, but there is a spectrum there and we help with all those things. And I'd say what makes us a little unique relative to maybe some of the other competitors, which are great firms, are just our infrastructure allows for not only the banking part, which is like doing all the analytic work, the valuation work, the document negotiation work, and the strategy behind getting the best deal for someone, but also if it's a buy side, they actually acquire the firm, integrate after most bankers leave the room. If they're on the Dynasty platform, our whole team, and even if they aren't on the Dynasty platform, our whole operations and onboarding and transition team is available to help make sure that goes smoothly. That's everything from data migration to making sure all the vendor pieces work and all the data, the client communications are aligned, and the transaction actually works on the other side. It's not just on paper that it looks good. And I think that part of it's really unique. And obviously we provide capital to accommodate and help support people doing things, which is a little bit different than some. But those things are really important, I think, to the success of acquisitions, because as we, I think, both know, and this is a broader comment to M&A, not all deals work out well, even though they look good on paper. And that can be a personality fit, that can just be implementation and integration. So that part, I think, is important. And on the sell side, where we're raising capital, we all know who the participants are. But I'll just give you an interesting fact of something I was working on recently, where there was a one-off conversation, which we all know happened, right? It happens, right? Because there's a friend of a friend.
Yep.
And they put something on the table saying, hey, you don't need to run a process. You don't need to like have any conversation with anyone else. And lo and behold, we say, hey, look, that's really not the right approach for anyone, whether it's us or someone else helping create some tension. And this goes to like our partnership. Like, how do you lay out all the options for someone and get to the best outcome? And that may be selling the business. It may be going to some other platform, but laying it out and comparing it. The delta between that first conversation from an EBITDA multiple perspective and where we ended up was 7 turns of value.
No.
So running that process and really thinking through that, your strategic options, which could be all the way from just going to a different platform to raising money to selling the firm. Those things really do matter in terms of how you approach it and who you partner with. And that's true for legal and tax and obviously banking. But I think with our partnership, it's also really, I think the extension of that is it's not just about capital raising, it's comparing all of your options in a way that from an advisor or newly minted CEO's perspective allows them to really think about the best possible option out there for them personally. And it's not always about money.
No doubt about it. We'll talk more about our new joint venture between Diamond Consultants and the Dynasty Investment Bank in a bit. Just one overarching question just about hiring an investment banker in general. Obviously, hiring a banker, it's a big decision. It's an important one. A lot of folks would say investment bankers are expensive. I'm sure you'd have a good counter argument to that. But what would you say is the biggest value add of any investment banker to a sale or capital raise process?
Look, I think it's all fair points. And I've, as I mentioned earlier, personally been on the other side of being pitched by bankers and hiring them as well on deals and managing them. And I think the bottom line is any good banker is going to more than pay for themselves. And so what do I mean by that? I think it goes to my last comment where like you start a bilateral conversation and then you run a process where you create tension. And it can be tension between an option where you're leaving and going to a different platform for a revenue multiple on your book, or it can be all the way through to raising capital and or selling your business. But you need some tension in the process. And if you create that tension, you can get a better price, number one. You can get better terms, number two. And that goes to governance, right? So the more tension you have in the process, if it's run well, is going to get you a better price, better economics, and better outcome from a governance control and deal term perspective. And there's a lot of different values, just one piece of it. Lots of people say they got X times EBITDA, but in which security did you get it? It wasn't preferred above you and above your employees. or was it common? And if it was a preferred, there's 10 different iterations of that really matter in terms of long-term value, especially if you're keeping a big piece of the business and getting a second bite of the apple, if you're raising capital and or selling 51% of the business. So I think from that perspective, bankers help with that, create that tension. And then second, when you get down into comparing your proposals, there's a wide spectrum of what people are telling you is the best deal. You need good objective advice to tell you which is the best deal and be objective about comparing them. And then three, when you get into the documentation process and you're working with tax advisors and lawyers and going through deal documents and structuring, I've seen in a lot of instances where a lot of value is picked up on that. Number one, it's a control issue on the back end and making sure that everyone's coordinated from a tax, which can make a big difference, and legal on the deal documents, but then negotiating the sign to close adjustments, the earnout structures, and making sure someone just doesn't print a big number up front, but they never actually get those proceeds because someone wasn't paying attention to the actual deal structure. And I've seen millions and millions of dollars be picked up between signing and close on something as simple as purchase network and capital adjustments. And really, for anyone who's not familiar with what that means, is like you sign a deal, you got a certain amount of cash on the balance sheet, and then you've got adjustments that can matter, but like on how much is being moved over, or how much revenue is being moved over. And they'll typically be, especially in the higher price bids, some structure on the security, but also on the earnout, and just making sure that you manage through that and get the right economic outcome. And you're not just blinded by the shiny light over here of like the high price, but you actually are thinking about how much of that high price am I actually realistically going to get and when, and how much risk am I taking to get that? And that a good banker will do a really good job at making that simple, clear, and easy to understand for someone trying to make that decision.
Yeah. I always joke around that like everyone has their friend who got a 18x multiple or they sold for 10x revenue. And like the first question is always, what was the structure? Was it 11x and then there's 7x if they double the business in 3 years?
Yeah,
or
exactly.
there's a lot of considerations around the structure. And I would agree with you. I've seen it firsthand that just having someone who this is their full-time job. Advisors get one chance to sell their business. They probably haven't sold a business before. Maybe they've done one transaction. If they raise capital, then they're going to sell the whole business. But working with a banker like you or anyone who's done dozens and hundreds of transactions, you've seen all the tricks, you've seen what works, what doesn't work, et cetera, is absolutely invaluable. And I would agree with you that the price tag might seem scary at first, but ultimately in your example, if someone got 7x returns on EBITDA from selling to their friend to running a competitive process, and that's probably a pretty stark example of what it normally looks like. But even if you can get 10, 15, 20% more on the sale of your business, that's more than going to pay off for what an investment banker costs.
Yeah, I'd say price is relative to the value that's being delivered. And in lots of cases, we will structure it where there's an incentive fee component where the client gets to decide if they felt like it was well worth it to pay the full amount of the fee. And I think you just want alignment here. The important part of when you structure any agreement between whether it's advisors and client, like making sure there's alignment on the outcome. At the end of the day, you want to trust a banker to get you a great deal and not push you to do a deal at the end because they want to get paid. I think that comes down to trust in someone. If you're a good banker, you will think long-term about your client relationships and realize that there'll be many more to do with a client. Even if you're selling a business, your reputation in the market and reputation with that client lives for a very long time, both positive and negative. Anyone who wants to be in this business for the long term in a credible way is going to make sure that clients don't just pushing them to do a deal. You're giving them the facts and the tools to make the right decision and supporting them, even if the right answer is don't do the deal.
Yeah.
And oftentimes we tell people not to do a deal, even though at first they're really excited about it. They think it's a great idea. But then when you do the math and you dig into diligence, our job is to make sure people have the right advice and make the right long-term decisions, and whether it's buying or selling the business or raising capital. So that's an important piece of it in terms of how you structure and pay bankers. I've been on both sides of that negotiation and discussion. And I think it's really important as people think about how they're engaging with bankers that they make those good decisions. Harris and I just grew up in large banks, and we've handled transactions personally up to 27 billion for public companies. These transactions, while they're smaller typically, they're just as complex, and maybe in some cases more complex, especially with all the creativity with private equity in space, which I know you'll get into in a minute. The deal structure spectrum is really wide because people are really creative about how they sell capital into this space.
Yep, well said. So I think that's a good pivot point. So let's talk about our new joint venture. It was a joint venture that was announced between my company, Diamond Consultants, and your Dynasty Investment Bank in October of 2025. We're calling it the Breakaway Bank. Can you talk a little bit about the genesis of this relationship and why do you think now is the right time to strike while the iron's hot? And I'll give my perspective after you share yours.
I think that one, the genesis was, and I'd love to hear your perspective on this too. We saw the need of big teams leaving wirehouses, needing capital, needing good advice. So integral to the ecosystem in terms of laying out the options for high quality large teams. And you're in those discussions advising clients on which approach to take, marrying that independent advice with everything from going to another platform to going on your own, I think was a good combination because it's just an extension of what you guys already do so well, in bringing the analytics and the mindset of here's what your business could be worth, like really running the P&L, doing the analytics, talking about how we're going to raise capital, how you're going to be buying companies in the future and developing those plans so that when you're looking at, hey, should I go in this direction and go to some other platform, or should I start my own business? Here's what it really looks like in 5 years, and laying out the economic framework so you can make an apples to apples comparison and at the end of the day, make the best choice. And I think combining what we do together has made that a really interesting offering for folks that are considering one or the other, or maybe both, but they don't know what the best option is. And I think what we've seen is the larger teams are more complex. Typically, they've got larger team dynamics. So equitizing everyone, developing those equitization plans, incentive plans, think about raising capital, which oftentimes those big teams that are transitioning need capital. And so how do you source that most efficiently? And what's different versus an existing RIA in terms of raising capital, they're 3 years historical financials, they're audited, investors know what they're looking at, whether it's bank, financier, or equity. But when you're breakaway, you have to build the future as though it will be based upon the portfolio and analyzing that and looking at cost structure. And you have to build a whole business plan out to make the business financeable. And then, as we all know, the confidentiality around that transition is so important that going out to outside capital has to be done very carefully with ultimate confidentiality so that a transition is not something that's a bad experience for the advisors in terms of running afoul of any of the various regulatory or non-compete pieces. So just handling that process and finding the right partners, I think, is a real need in the market. It's hard to deliver, and it's not something that traditionally people have focused on, or even private equity has been willing to finance because it's a breakaway and not an existing business. And I think that's where us bringing our respective expertise together to really help people make the best decision is, we think there's a real need, and we think it's going to be really well received.
To me, the biggest reason that we've embarked upon this journey together is there's some very large, we'll say most mini RIAs or mini firms that just happen to be employed by a major wirehouse. They have a large headcount. They might have a COO. They grow organically. They have an investment committee. They have next generation advisors. They train folks. They're doing all the things that any independent business would do. So as we look at these businesses, they're left with a much, much larger slate of options than ever before. Of course, they can always go from UBS to Morgan Stanley, and we'll help them with that. They can go from Merrill to Rockefeller or Ray J, and we can help them through that process. But I think we're at the early innings here of large, we'll say billion, $2 billion, $3 billion and up teams that are big enough and sophisticated enough and are real businesses where for the first time, they can garner the attention of a private equity sponsor buying a stake in the business, or a family office, or a platform itself can invest. And at the same time, too, just given where multiples are in the space, and we'll talk about that in a little bit, we're seeing practices from a wirehouse or from some sort of captive environment decide to sell the business lock, stock, and barrel at time of transition. And that's a new dynamic. It used to be you had to take the business independent, season it for a period of time, and then run a process to sell it. But now we're seeing folks want to skip a chapter or two, saying, hey, I have all this value that's locked up in my business. I can trade my business to another wirehouse or another firm for W-2 income and a forgivable loan. I can sell, with air quotes up, internally for a succession deal, whether through UBS's Alpha, Merrill CTP, Morgan Stanley's FAP, et cetera. That's ordinary income. It's highly structured and not necessarily the best deal. So we're seeing these big teams really think of their business as a business and are considering for the first time is selling the business to a strategic buyer. And while we've done transactions like that ourselves, we realize that the why now is advisors want to really understand the full spectrum of options. They want to see what it looks like to go to a wirehouse. They want to see what it looks like to launch as an independent, grow the business, sell it down the line. They want to understand what it looks like to sell a piece of their business today. They want to understand what it looks like to sell their business to a strategic buyer at transition. And we think that combined, we can really hit the full spectrum of the space in a way that's never been done before. So we're very excited about it. It's early innings. We're already starting to see some early success. And I think too that the why now is our firms collaborated on the OpenArc transaction from Merrill into the RIA space. By my count, it's the largest transition ever facilitated in the history of the industry. And that was a true team effort where we helped with education, building out the dream of what it looks like to be independent, being there to develop the relationship. And then we brought in Dynasty to help build the infrastructure, help launch the firm. But a big part of that launch was how to access capital, was how to create an equity compensation plan, how to think about the value of the business, and really positioning the business so that the founders of the business have optionality for the future. Even if they want to just keep the business in the family and sell internally for the next 50 years, they can do that. Or they're making intentional decisions from the jump that's going to benefit them if they look to raise additional capital or they want to sell the business for a boatload of money 5, 7, 10 years from now. So thank you for letting me rant here. Usually I'm the one asking the questions, so I'll get off my soapbox and turn the mic back to you. I hit on some of this, but we'd love to, if you have additional perspective, what do you think is the gap in the marketplace that we can collectively fill? There's a number of investment bankers in the industry. There's more specialized banks. There's more of the bulge bracket type banks. What do you think our collaboration is going to be different in the market? What's it going to represent differently?
It's a great question. I think that what's different is when you bring to a client or a prospective breakaway team, as you described it before, being able to show someone credibly what a deal looks like to go to another wirehouse, as you talked about, all the way through to what it looks like to raise third-party capital, both equity and debt financing, maybe in a minority piece, to then acquiring businesses along the way inorganically, and then how to ultimately monetize and create wealth for the partners, which may be through a majority sale to private equity, maybe to a strategic. That whole life cycle and process, I think, requires a couple different things. And what we think is different about what we're doing together is most bankers focus on existing RAs. It's a growing market, it grows every year, it's precipitously, and it's a great market. And we do that too. But what's really unique is being able to bring your expertise to bear, both operationally, really knowing the landscape, to someone considering breaking away and launching their own business, or breaking away, just wanting to know what the options are. We have experience not only on the banking side in terms of structuring the deal, but on the operations side and on the technology side and on the practice management side. So we feel really good about when we underwrite something and help advise someone, they have a really high probability of being successful on the other side. So when you look on paper at why you might pick a path, the path is significantly de-risked from an execution perspective. So it's not just a plan on paper, but there are real people behind that plan that you can get comfortable with will help you execute that. It doesn't mean it's the path for everyone, but I think as you look at your options, the probability of success in accomplishing those is really important. As a prospective CEO or founder or leader of the business, you want to manage risk. One thing I've learned about entrepreneurs along the way is they take a lot of risk, but they're actually really risk averse at the same time because it's their baby. It's like their life's work, and they don't trust it to just anyone, and they trust but verify and measure maybe 4 or 5 times and then cut once. And so just understanding like how you're going to get there in a very granular way is helpful. And then I think part of that is, can you help solve the monetary need or the capital raising need? Part of that is the execution, de-risking. And part of that is the future of like, how do we set you up for success in terms of all the things you talked about, which aren't necessarily things you charge someone for, but you help them with along the way, like developing the right incentive plan, the right cap structure, all that stuff. That just sets the relationship up where you're helping them build, and I'd say almost in a consultative way, the approach. But then when they need capital, you're helping them go get it. And you're helping, if they're buying a company, you're helping them with the post signing integration and making sure those transactions actually work well. So those are some of the things where we are focusing our attention on the breakaway market, which maybe feels historically a little less banged than the existing RIA market, but they have the same needs because they're thinking about how are we going to execute this and what's the best path. And I think from that perspective, we make that opportunity financeable for third-party capital because we have the credibility to say, we've done this more times than anyone else at significant scale. And here's our underwriting case in terms of the plan, the 5-year plan in terms of the P&L, and here's the financing plan. And here's why we believe this is an underwritable case for someone, either bank financing and or financing with equity. And we've partnered with a number of private equity firms along the way, helping them understand how they can invest in these type of opportunities. And what you need as an entrepreneur, and you're considering this, as someone who can help you create the most tension. So the more folks that understand that it's investable creates more tension. It has to be in a very controlled environment from a confidentiality perspective. But building that framework in a credible way is what will allow you to have your company prospectively valued at a high multiple, and for you to be able to raise capital at an attractive level, not just waiting 3 or 4 years to do it, but doing it at launch. And I think that's the big difference is we know it's doable at 3 or 4 years. Everyone knows that, and it's heavily banked by many good bankers. But day one, if you want to get that kind of multiple, it's more complicated. And that's where I think our combined expertise really is different.
Yep. Yeah, I think that's exactly right. I see the same thing where I feel like it's almost like a evolution of the space where for the last couple of years, the big RIA acquirers would turn their nose up for the most part at a team from a wirehouse. They're not the right cultural fit, or they don't own anything. And same thing with private equity. Like, hey, we'd love to buy a wirehouse team, but they don't have infrastructure. They don't have tax returns. They don't have a P&L. What if only 92% of the business comes over? We don't know it's going to come over. But now, at least I'm starting to see the big RIA acquirers, oftentimes backed by private equity, are raising their hand and saying, hey, like, we're interested in this. But they really need a lot of education and understanding of why it's a good market. And on the flip side, I'm not going to say putting lipstick on a pig, because these are amazing businesses, but it takes someone like you, someone like me, to really tell the story to a prospective buyer or investor about why this is a real business, what their portability characteristics are, the unique elements, pros and cons of coming from a wirehouse or a captive firm. I mean, for me, the big reason why we opted to partner with Dynasty's investment bank was just a mutual respect and understanding of the mindset of a wirehouse team and just what some of the unique elements are that I think oftentimes go underappreciated. And it's the small details in these things that make all the difference in the world between what's the deal structure going to be, who's going to be interested. Because if someone who's not as understanding of this market brings a business like this to market, they're probably going to a handful, we'll say the low-hanging fruit, but it's that next wave, the next level of private equity firms Maybe it's the emerging acquirer who's not as well known. And I think that's what our collective efforts can do. Let's talk a little bit just broadly. How do you see the evolving wave of breakaways from wirehouses? What are some of the biggest changes you're seeing right now? And as far as either movement of these teams or just what you're seeing in the marketplace in general?
Yeah, I think there's a couple themes, and you mentioned one earlier, which is the whole concept that corporate benefit oriented teams now can do it independently. I think that's a very big change recently from a mindset perspective. So that's one, I'd say, major theme, which is significant in that there are a lot of large teams out there that have had that business in the past and haven't really felt comfortable about going independent as a result. I think that's changed. What's also changed, I think, is that breakaways of large teams are starting to happen. Like you said earlier, these are really businesses inside of a business. And it's almost like a carve out, really, of a large, what we would think of historically as a carve out of a business line or a division of a company, because it's sophisticated and it's complicated. And there are a lot of needs that are more complicated than I think in years past with smaller teams. And that lends itself to needing that kind of advice and that kind of help to make sure you're making the right decision as a leader and you have all the facts. So I think that those size and complexity and then corporate benefit pieces, I think those are meaningful changes that we've seen. And the other thing that we're seeing is just continued interest by different flavors of capital coming into the space, and that capital being willing to think through financing breakaway before the business actually exists. And how do you do that, right? And how do you understand what the underwriting is and the probability, to your point, of the portfolio coming over, and how do you put capital against that, structure it in an efficient way that is both good for the capital providers and also, importantly, good for the team and the company. And that, I think, there's more openness to that and more focus on that than there has been in the past. So I think those are all great developments for someone who's got a great business, but is not yet independent and thinking about it, because it's a more well-trodden path now than it had been, not just on the operations and technology side, but on the capital side. And that benefits you as a CEO or leader of the business and your team with a better valuation and more efficient capital structure, and ultimately more value creation in the long run. And I think that development is just moving more toward the front end of the life cycle than it has historically been. But I think what's been really interesting lately.
Yeah, no, I completely agree. It's almost like in the past, I'd say 10, 12, 15 years ago, breakaways were less prolific. There were some, but my hypothesis is the early wave of breakaways had more plain vanilla businesses. They were just model portfolios, maybe some financial planning, just straight advisory businesses. But now every transition that happens in the space is further validation or proof that no matter the size of the business, the complexity, the types of clients, the alternative investments, the lending, as you said, corporate benefits, stock plan, et cetera, those needs can now be accomplished in the independent world. And of course, they can be accomplished in a multitude of different venues. But the fact that they're now available, and I would say even more than available, in many cases, it's a better way to go about serving clients. I think we're just going to see this trend keep going, because just as the market keeps growing, teams grow, businesses are going to get bigger, businesses are going to get more and more sophisticated. And I think we're going to see a ton of movement of very large teams now, maybe for the first time even, considering doing some sort of transaction or event within the RIA world. That doesn't have to mean I'm planting my flag, hanging my own shingle, and building a business from scratch, and really deferring the financial windfall until 3, 5, 7, 10 years, or even later at retirement like it used to be. A similar topic, how do you think private equity, and everyone reads about private equity within our space, there's every big RIA seemingly has a private equity backer. They're everywhere, and they're coming out of the woodwork to deploy capital in the space. How do you think the emergence and growth of private equity within wealth management is impacting the mindset, or kind of just we'll say the decision tree of big wirehouse teams or big IBD teams that are now thinking about the future?
Yeah, I think the way it's changing people's mindset is just, more aware of what's possible, right? And the probability of raising capital finding a partner that works for you is better now than it's ever been. And look, the price band. I think if you run a competitive process and do a good job and have a good banker involved, there's probably a pretty definable band. But going out and then parsing through the structure, like I said, it's very creative across the spectrum with different private equity folks or capital providers, family offices, a lot of creative structures. So parsing through that, really understanding it, educating yourself, being educated, like doing the work to be educated and be prepared to understand like a 20 times multiple with a heavy pref and a pick and very back-ended economics with restricted governance may not be for everyone, right? But understanding what those things mean and how they're positioned, I think is important.
Do you think that private equity being involved in the space, has that been a catalyst for valuations increasing? Is part one of the question. And then part two is, has the run up in valuations in general, do you think that weighs on the mindset of a big team, whether they're at an independent BD or they're at a wirehouse, they're at a private bank, really considering venturing into the independent space, either to build or to transact?
Yeah, it's a couple of different questions in there. I think on private equity, in terms of valuations, I think, look, it's a supply demand point, and the more capital going after this space, which is, by the way, a great space for private equity, right? It's low capex, high cash flow, ripe environment for making inorganic acquisitions at the same time. There is a lot of organic growth given the lack of advisors, as we know, in a declining population, but yet an increasing need. So it's got all the long-term dynamics of why you would make an investment as a private equity firm. And I think advisors, are looking for solutions, whether it's acquisition financing, whether it's getting some chips off the table from some partners as they're getting older and want to, make sure they're actually following their own advice that they would give to clients, which is diversify. Don't just have think about your estate, your family, what would happen to you if, heaven forbid, something happened. Have you taken some chips off the table? Do you have a business that's saleable in the event you're not there anymore as the primary partner? Those are all things, along with obviously succession planning, that I think private equity is bringing a professionalized view into the space, helping to make those pieces more standardized, and in many ways helping people monetize their businesses in a way that they had never been able to do so before in the context of being acquired by strategics. And that, I think there's still a healthy bid from strategics, and that's really important as well from a private equity perspective, because at some point the private equity firm is going to want to sell, even though they may be really long dated. So having a strategic bid in the market from the bigger players who are still consolidators, and probably in the near term, in the next 4 or 5 years, will in and of themselves end up going public, depending on the IPO market, but they're getting big enough to make that a real consideration. So there will be a back end takeout bid that will make the front end private equity investments want to pay more, because they'll know there's a good backup, there's a good opportunity for exit and a good buyer universe. But along the way, they really help professionalize platforms. And look, I think there's a big spectrum of private equity and personalities too. And I think there's not going to be one size fits all. I think you just want to lay out for clients, which is what we do, like the fair options. And then a lot of it's going to be personal fit and with principals, because at some point you're principal and all of a sudden you've got to have a board, right? And you've got to make joint decisions and sit in a boardroom and talk about like why we want to do certain things, whether it's pay people or buy a company or get financing. You want someone who's been in the trenches with you, has some thoughtful advice. But I think depending on where you sit, there's advice and then there's telling you what to do. And I think there's different flavors of that. And part of that's just a little bit finding the right fit personality wise and the right fit and where people want to be and what they want out of the engagement with someone who's going to be a capital provider. And there's those that are like very strategic, the consultative types. And then there are those that are like, look, check in once a quarter when we're good, as long as you're doing a good job. And I think that's a personal decision that we try to give everyone, listen to their needs on the front end, and then try to find them what we think are the best options and what they're interested in accomplishing.
I would say the dynamic I'm seeing too is probably every advisor, no matter where they practice, has heard of, whether it's true or not, some crazy valuation that a friend got or they read a news article. And that kind of, it almost like brings light to the dream. you can't talk someone into wanting to be an entrepreneur, right? Like they have to have the fire in their belly. They have huge opportunity costs. They're leaving deferred comp on the table. They have an opportunity cost of not getting a 3.5, 4x deal from a wirehouse. So it takes a lot. But I think seeing now that firms that if they're built the right way, either at time of transition or at some point in the future, can be sold for ridiculous numbers that far surpass typical deals, that I think that kind of just like painting the dream is a catalyst in and of itself for breakaways and just in general for folks wanting to enter the independent world in some capacity. Let's talk a little bit about the wirehouse sunset deals or retire in place deals. So the dynamic of I'm 63 years old, I want to retire in 5-6 years. I have my team at my firm and I don't feel like moving. I know I can probably get more by moving, but I'm happy enough. And I can get a 3x sunset deal for entering that program. So I think a lot of our listeners are familiar with it. We don't have to go deep, but I'm sure you come across that competitively where someone is weighing, as they should, a retire in place deal at a wirehouse or at really any W-2 firm. How would you help them think through the pros and cons of doing that internal deal versus transacting the business?
Yeah, it's a great question. And I think if you stay in place and take the deal, it's easy, right? So there's that. And nothing changes in your life. You sign a piece of paper and you continue on. And life's not that disruptive and there's no sort of process to go through. That said, I think really worth getting really solid legal advice and thinking through, like, each firm has a different flavor of that.
Yep.
It's really important to get advice on what's market there and what's not, and making sure you're not getting taken advantage of. But as you compare the best case there versus building and running and launching your own business, 3 times to 4 times revenue multiple is somewhere like in the equivalent range of 10 to 13 times EBITDA multiple at a 30% margin. You can do the math versus if you launch your business, transition your assets, have reasonable growth, you're looking at a market that's 18 to 20 plus times multiple of EBITDA. And when you go and sell that business or transition it to G2, it's equity that can be transferred. It can also be sold at cap gains rate, not W-2 income. And being a K recipient is also a lot more tax efficient than being a W-2 recipient. And so it also allows you to do real acquisitions. So if you're at a wirehouse, you've got a big team and you're like bringing on teams, recruiting, but not really, you'd have a point of view on that, Lewis. But when you own your own business, you control the cap table. You can use your equity for accretive acquisitions. What I mean by that is if an acquisition that you're doing or a tuck-in or a recruiting deal that you're issuing equity for means that the earnings per unit that you had before you did the deal is improved by doing the deal, that means it's an accretive transaction. Obviously, you've got to do the modeling, the work, and the diligence, but just that activity alone of going out and doing accretive deals with your own currency, as opposed to doing it inside a broader organization, combined with the tax structuring benefits, is pretty compelling opportunity. Now, like all great opportunities, you have to do a lot of work to get there, which means you've got to launch, you've got to get financing, you've got to develop equity plans, you got to deal with all of the parts of like launching a business. And those are things that, you can get help with, whether it's from someone like us or there are others. But you have to, I think, lay out your options, which I think combined between the two of us, you're going to have a very good waterfront with, I think, very comparable, easy to understand decisioning trees. But then once you go do it, we're not saying it's to flip the switch. It does take work. But I think the reward on the other side is you get to control your brand. You're not inside of like a compliance nightmare at a big firm. You can do things and pursue business opportunities that you never would have been able to do. You have complete independence of the products you use. You get to make your own hiring decisions and actually like compensation decisions. Now, there's the flip side, which is you have to make those compensation decisions. But being in that position and really controlling your destiny, controlling your brand, building a business, It's not for everyone, but I think it's for more people than people, realize. And I think once they're educated about what's possible, that retirement deal for those that are motivated, and in particular, those that have family in the business, really care about their clients' long-term success. It's a really compelling opportunity for someone to explore. And I think the way to do it is really educate yourself, understand all the options, be deliberate about that, and think through the tax implications, get a good tax advisor. Those are all things that I think will make someone successful in going down that path. That's how I look at the world, comparing those two. And I think inertia often guides people toward, hey, it's too complicated. I'm just going to take the deal versus taking the time to unpack all that. But with the right help, when you lay out the options, the answer is quite clear if you're willing to do the work.
No doubt. Yeah, I don't disagree. It's the proverbial bird in the hand. I can get 3x my trailing 12 or 2.5, whatever the deal is, paid over a 5-year period. I keep my deferred comp. I don't know if the transition, that's a lot of money, and it's probably more than enough for a lot of people. But my viewpoint is, if you're thinking about how do I maximize the ultimate value of the business, and also how do I potentially optimize the client experience and just be somewhere that supports the growth of my team and allows my team to better serve my clients, it's not a no-brainer because it's a lot of work and risk, et cetera. But if you follow the math, it tends to be a pretty stark difference pre and post tax if you decide to transact your business at time of transition, like we're starting to see, or in Sam's example, like your example, building the firm, doing an acquisition or two, and then selling for a crazy number down the line. Let me just ask you 2 more questions to wrap up. How would you describe valuations today? Do you think we're at the top? Is there room to run? Are they high? Are they low? Are we in a bubble? Like, what's your comments on valuations today?
I think they're certainly healthy. So if you're thinking about doing something, now would not be a bad time. But I think the universe of opportunity and growth is really what drives valuations. There can be more discernment around large platforms that are in their power curve of growth and margin expansion, where there's real opportunity for multiple expansion, is where you see really strong organic growth, demonstrated inorganic growth done on an accretive basis, and where there's a strong management team that can grow with the business. There's a lot of leverage in business operations. That's where you see the best multiples. The lifestyle businesses, while still fantastic, the smaller end, you may not have scale and margin that the middle to larger two players have. Still really healthy, but there's more discernment there. If you're a smaller team, it's really important to understand the equity you're actually receiving. If you take a deal, you're getting equity in a larger platform. The relative value of that equity negotiation and the future of that platform and their objective in terms of creating wealth and ultimately exiting, like, that's a key important and very important decision for a seller of a smaller platform, because one, you're kind of losing control, but two, you're taking a bunch of equity of that larger organization and you need to really do your work. So I think the span of valuations, you were talking from middle teens up to 20s, and the spectrum is also heavily influenced by structure. Adage, like, you tell me structure, I'll tell you price, and vice versa. So understanding the interplay between structure and valuation is really important. Most people love to talk about what a great multiple they got, and the conversation trails way off when somebody starts asking, like, well, how much money did you get? What was the structure? And where do you send the waterfall in there? Like, well, there's a little structure. Yeah, it's a little bit. Turns out there's a lot. And maybe they're never going to get that tail that they thought they were going to get. But they loved having the cocktail discussion of, like, trading at some big number. People should be really objective and really thorough in their analysis of what the opportunity is. And at the end of the day, you can't take home a headline and put it in the bank. You have to money that clears, equity that's worth something, that's eventually going to have a real exit. And the probability weighting of that is really the multiple that you're working on. It's not the headline multiple.
Well said.
And I think the two are very different. And it's important to think through that carefully as you hear these multiples thrown around, because they're not all equal.
Yep.
And that's the creativity around dressing something up and making it look good, but protecting investors, which means you really didn't get that multiple unless you perform exceptionally, maybe above your plan. That has to be carefully evaluated when you're hearing these multiples and when you're receiving proposals, that's really important, is what I
Well
would
said.
say.
So, give you one word answer. Do you think valuations will continue to increase?
On balance, yes, dependent upon a couple key things. One, the Fed, right? Like if rates and financing markets continue to be permissive and maybe even get a little bit better, that's just going to affect multiples going up. And two, I think efficiency and technology. We didn't talk about AI, but probably should have. The ability of technology to create better margins, improve operational efficiency is, if you believe that, it has to improve margin over time, which therefore increases valuation. And so I think those two fundamental shifts, along with more accessibility of high-end product in the market that continue to drive higher margin fees for advisors, those three things I think drive multiples modestly higher over the near term. And part of that is also the longer term opportunity to do inorganic growth. And we hear every day about a deal that's done, which reduces the pool. But we also hear every day about a new firm launching and going independent.
Right.
And so the opportunity and fragmentation in the market gives a capital provider hope and a thesis for saying, if I can improve margins and if I can buy companies accretively, there is a large market for that doesn't seem to be dissipating anytime soon. In fact, it's accelerating because it's easier and easier to go do it on your own. And I think those factors lead us to believe that we're still in early innings as an industry from a multiple perspective, and from ultimately, as I mentioned before, a big cohort of these companies. Remember when alternative asset managers weren't public, right? We're going to have a really big group of RAs that are ultimately public that I think have a different complexion than maybe some of the prior public entrants that were more roll-ups. These will be integrated, single branded, very high growth, good margin businesses that have a diversified client base and a really strong offering in the market that are going to be continued acquirers. So those dynamics lead to what I was talking about in terms of the trend.
Perfect. I asked for one word, but honestly, your answer was awesome. So I don't mind that you skirted my rules.
Oh, sorry.
That's a great place to end it today. I think we'll do these episodically because there's just so much more information and other concepts to unpack. But this has been terrific, Sam. I very much appreciate you taking time out of your busy day to speak with us. I learned a lot just about valuations, structure considerations, different things for breakaways to weigh, what it means to hire an investment banker, why there's an ROI there, et cetera. Very much appreciate you sharing your wisdom.
Thanks for having me. I really appreciate it.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.